the same message that this following talk has been approved by the California Insurance Department for continuing education credit. If you want to receive that credit, you'll need to locate, fill out, and return a Google form that you should find in the chat. You need to. There'll be two such presentations. One earlier today that was on the topic of social inflation, and then this topic. Both of these are eligible for continuing ed, but you got to fill out a form for each one of them. So hopefully that process is working for those who want it. Switching over to this topic, as I thought about it, and it's my good fortune to have, a number of colleagues that work down at the California Insurance Department. And I thought, particularly in this era of divisive politics, it's kind of amazing if you think about our history as an industry with our regulators, that there really does seem to be a strong element of respect between those being regulated and the ones regulating them. Frequently we disagree with one another. In fact, that's generally the reason why we're talking to one another, is that, there's an area of disagreement that needs to be cleared up. But at least in my experience and the experiences that I've been able to observe, we keep the focuses on the issues at hand and, get that one settled, because we know another one's coming right down the pike. So having said all of that, and having observed the last couple of years, these have been difficult times for all of us. But I think if we think through the job of insurance regulators and wildfires and this and that and the other, it's been a particularly difficult couple of years for them. One thing though, and one of the reasons maybe Ken and Annie were so happy to come today, is that I gave them an incredibly easy task. And that was to find interesting current issues in their field, because their field is full of them. And probably after they got so excited about the ease of the task that I given them, then they realized they just had to pick a few, and that probably was a difficult task. So we're really looking forward to Annie and Ken to hear what you picked. And by way of introduction, let me introduce the two speakers and then sort of get out of their way. Ken has been the Deputy Director of the Rate Regulation Branch in the Insurance Department since September of 2016. He's a graduate of Cal State University Fullerton with a BA in mathematics. Ken has been with the Department of Insurance since 1989 and currently serves on the Board of Directors of the Insurance Regulatory Examiner Society. He was the 2017-2018 president of that society. So certainly Ken is an experienced regulator and whose remarks will benefit from. Annie Chow is a bureau chief of the Los Angeles Rate Filing Bureau. Her team protects consumers from excessive, inadequate, and unfairly discriminatory property casualty insurance rates. She joined the Rate Regulation Branch in October 2013. She's an avid traveler, gourmet, adventurer, and likes to spend lots of quality time with her family and friends. Unfortunately, I suspect in the last few months, it's been much more with family than with friends, but that's a common fate of all of us. So let me get out of the way and let Ken and Annie in and take it away.
Okay, great. I just want to make sure that everybody can see the screen that I'm sharing.
Looks great on my end.
Okay, perfect. Okay, so hi everybody. Thank you so much for joining us today. Ken and I are really excited to be here under this virtual format. Hopefully we can get through this presentation without any type of technical snafu. So with that, I'll go ahead and jump into the agenda that we have. There we go. All right, so today we have four main topics that we'd like to discuss with you. The first topic deals with COVID-19 and how that's impacted the Department of Insurance. We are going to focus on the Rate Regulation Branch, where Ken and I both work. And as some background, in accordance with Proposition 103, the Rate Regulation Branch regulates the rates and rating plans of insurance companies selling property and casualty lines of insurance. We ensure that rates are not excessive, inadequate, or unfairly discriminatory. In the second topic, we will discuss parametric insurance products. In this section, we'll provide a high-level review of parametric insurance and give an example of a parametric product that has actually been filed with us. In the third topic, we will discuss issues that the insurance industry finds problematic with our current regulatory framework, and Ken's going to be discussing that section. He'll also discuss the fourth topic, and in the fourth topic, he will go over different legislations that can affect the insurance industry, and he'll go over some general points about the two specific bills that's listed in the agenda. And lastly, not listed in the agenda, we're also going to go over some exciting job opportunities here within the rate regulation branch. So, how has COVID-19 affected the rate regulation branch? Well, luckily, 3 years before the pandemic, our branch was forward-thinking enough to implement partial telework as part of our continuity planning. This enabled the rate regulation branch to continue operations rather seamlessly once we made the decision this past March to telework 100% to keep our staff safe. When we made the full transition, the department made it a point to focus on 3 goals to ensure optimum productivity. The first goal was communication. So keeping an open line of communication internally with teammates, with insurance companies, and with the public has been a top priority. While it has become difficult to answer direct phone calls or to meet in person, technology has allowed us to connect virtually through Microsoft Teams, WebEx, Zoom, or Skype. Our second goal was flexibility. So what this means is that we acknowledge that most folks are working at home with their kids wearing multiple hats. And because of this, there is an element of flexibilities for companies and internally for work hours, work needs, and timing. Our third goal was productivity. The department as a whole is moving towards modernization. As an example, prior to the pandemic, only 70% of our workforce had laptops and could work from home. By the 8th week into the pandemic, the department increased that statistics to 85%. The department continues to take an active role in searching for creative ways to use technology to modernize our processes and to ensure optimum productivity. As stated earlier, all the teams within the rate regulation branch are working remotely. The challenges that we have faced internally have been minimal. The most significant challenges stem around maintaining relationships and communicating through a virtual platform. Another challenge has been recruiting new staff under this virtual environment. We'll speak more about that towards the end of the presentation. So, how has COVID-19 impacted current rate filing process? The rate regulation branch recognized that COVID-19 has severely curtailed the activities of policyholders in both personal and commercial lines. As such, our branch sent out letters to all pending rate increase filings. These letters were sent to the following lines of insurance: personal auto, commercial auto, workers' compensation, commercial multi-peril, commercial liability, medical malpractice, and to any other line of coverage where the measures of risk have become substantially overstated as a result of the pandemic. These letters informed insurers that their projected loss exposures based on pre-COVID-19 data may now be either overstated or misclassified. These letters then asked companies to reconsider their proposed rate increase requests to see if they were still warranted or should be adjusted or withdrawn. Since then, some companies have withdrawn or adjusted their rates. For companies that still want a rate increase or to keep their original request, the rate regulation branch has kept these filings on hold until we can decide how COVID-19 has really impacted the data. Currently, it's still difficult to say what the new norm will be regarding loss exposures and their trends, since we are still in the midst of the pandemic. In the meantime, the rate regulation branch has taken additional steps to apply more scrutiny on customer dislocation and the impact these changes will have on individual policyholders. In April, Commissioner Ricardo Lara issued a premium refund bulletin for lines of insurance that were affected by COVID-19. Again, the lines are personal auto, commercial auto, workers' compensation, commercial multi-peril, commercial liability, medical malpractice, and any other line whose loss exposures may have been impacted by COVID-19. As a result of the bulletin, from April until now, under the personal auto line of insurance alone, we have seen over $1 billion returned back to California consumers. Since COVID-19 continues to be a significant issue, the bulletin remains in effect and the Commissioner continues to request for premium reliefs. In addition to this, the rate regulation branch is also reviewing whether the premium refunds provided so far have been sufficient. So now switching gears over to parametric insurance, Parametric products, what is it? Well, parametric solutions have been generally around since the late 1990s, but only more recently have they found their way into traditional corporate insurance markets. Whereas traditional insurance reimburses the insured for actual losses incurred and includes deductibles, limits, exclusions, etc., parametric insurance only needs qualifying parameters to be met in order for full limits to be paid, and typically payouts are within 30 days. Because of this, parametric insurance providers believe that there is less of a need for an underwriter or loss adjuster for a parametric insurance program. Parametric insurance is typically bought as a complement to traditional insurance rather than as a replacement, mainly because parametric policies can be seen to cover expenses which may otherwise be excluded from a traditional insurance policy. So, what types of filings has a rate regulation branch seen? Well, currently the department has seen filings for major catastrophes such as commercial earthquake. And in the example for commercial earthquake, there was a two-phase trigger that dealt with the magnitude and radius of an earthquake event. The magnitude trigger depended upon the magnitude specified in the policy. If an earthquake reached or surpassed a stated policy magnitude requirement, then the first trigger was met. And the way that the insurance company verified the magnitude is through reports from the U.S. Geological Survey at the time of the event. For the second trigger, the location of the property covered had to be within a specified radius of the earthquake's epicenter, and the insured was given the opportunity to set the radius prior to binding the policy. Once those two triggers were met, then the insured had to supply a loss notice to the company before payment can occur. This loss notice can be for any type of loss for any amount, and the payment would still be for the full limits purchased. We have also had a number of companies meet with the department on other parametric programs surrounding wildfire, flood, hemp production. Many of these insurance companies, however, ultimately filed these programs under surplus lines, although they have stated that eventually they want to enter an admitted basis and file those with the department. So now I will turn that over to Ken.
Okay, thanks, Annie, and hopefully everyone can hear me.
Yes.
All right, so I will. Okay, I will go ahead and Annie, Ed was right. Annie and I appreciate the opportunity to come here and present, and Ed was right. He did give us quite wide latitude to pick which topics we wanted to, and there were dozens of potential interesting topics, and we had to narrow it down. And even on any one of these, we probably could have spent a whole hour just on one topic if we really got into it. So I'll preface my comments by saying that I'm going to generalize quite a bit and very high level. Some of this could get into more detail, but I will speak in generalities. And so the first subject I'm going to cover is there are certain existing regulations out there today and that have been in existence for many years, maybe up to 30 years, that the industry would like to see changed and has been pushing to change. And so we'll go ahead and flip to the next slide. And the first one that I want to cover is something that we refer to as our intervenor regulations. And I will get a little bit technical on the insurance code, but California Insurance Code section 1861.05C generally states that rates, shall not remain in effect that are excessive, inadequate, or unfairly discriminatory. But there's another little subpart to that basically says that on any filing, there can be a public intervenor, or the public can petition to intervene on a filing. And that's part of Prop 103. And we do occasionally get intervenors. And I'll just kind of mention that on average in a year, we may get anywhere from 4,000 to 8,000 filings. And they could be rate filings, rule filings, form filings. And we might get about 20 filings intervened. So it is a relatively low number of filings where we do get an intervenor. However, when an intervenor does come into the picture, it does add time to the file review, and it could add anywhere from a couple months to even a few more months, maybe up to 6 months, depending on how technical the filing is, how complex it is, the issues that are being intervened. And it's not just the rate aspect, there are other aspects of the filing, whether rules are viewed as unfairly discriminatory, underwriting guideline issues, or what have you. So an intervene filing does take longer to get resolved than a filing that is not intervened. And the language that's very key here is for personal lines insurance, such as homeowners. If the rate increase is greater than 7% and there is an intervener, then the commissioner must hold a hearing upon a timely request. Now, I will say in my experience over the past few years, we haven't had that many filings intervene where the request was over 7%. There have been a couple, but in each case, through three-party negotiations, we were able to come to an agreement on what the appropriate rate change should be. So even though the initial request was over 7% and there was an intervener, we did not go to hearing because we do try to work out and get all three parties to agree before we get to that hearing step. But if we were to get to a hearing, hearings are very time consuming and do cost money. And the hearing aspect itself will add a number of more months to the review process. And again, this is all very unique to California. You won't find this intervener process in any other state. So again, my comments are specific to what we experience in the rate regulation branch at California. Also, the insurance companies will end up paying the intervener for their petition and their action on the filing. And the interveners will have their own staff. They may have attorneys. They may hire outside actuaries or consultants. And all of that does add costs. And the industry does end up having to pay for that. So that is another reason that the industry does not like the intervener process, generally speaking. Now, this past Monday, the department did hold an investigatory hearing on homeowners insurance, the availability and affordability aspect, and we kind of got into wildfires. And for any of you who happen to attend or tune in and listen to that hearing, not only this aspect, but other aspects I'll get to were mentioned quite often from a number of different parties during the hearing. And again, this was the 6.9 or 7% threshold that most insurers, not all, but most insurers will tend to hit that limit and stop there and not exceed 7%, because from their perspective, you know, it's more that it's purposely done that they'll stay at 6.9, even though the indication may be 20%, 50%. We've seen triple digit indications on some homeowners rate filings, but a company will still come in at 6.9. And they view that as the risk of being intervened is too great in going to hearing, potentially. It adds a lot of time, it adds a lot of money, expense, and resources to go through that. So they are choosing by their own volition, even though with a higher indication, to only take 6.9 at a time and then work off that, get that one approved, and incrementally get these increases instead of trying to get something bigger. And again, not all companies are doing this, but some, you know, most companies will stick to this and limit their increase to 6.9 because they want to avoid generally the additional time and additional costs that it takes in getting a filing to resolution that's been intervened and should it go to hearing. So let me go ahead and we'll flip to the next slide. And kind of the second area that I'll cover is with the concept of projected losses, or how insurance companies can project their losses in rate filings. And this is kind of a two-part step. So I'll cover the first part here under projected losses. So generally speaking, when a company is projecting losses for their next rate filing, they're going to look at the history of their losses. And high level, it's a 3 or even up to a 6-year look back at the most recent periods and taking the historic losses to project the future losses. But the issue here, and this has come up more recently, and it was kind of mentioned in the presentation before this and earlier, and I'm specific to homeowners kind of on this talk, is that with climate change, we are seeing some different patterns in wildfires and the damages and loss. So you look at the years preceding 2017, there were a lot of pretty good years where there were really very limited or no wildfire claims or losses in the insurance industry. 2017, 2018, 2 very bad years. A lot of it attributed to climate change in terms of the events. You know, they're becoming bigger, they're lasting longer. We've got more wind events, stronger wind events, and so on. And then you look at this year, 2020, And while we have had the largest number of acreage burned in 2020, the number of structures burned is still at about half or maybe a little over half than the worst year in 2018. But again, we're only 2/3 through the way October, and we still got a couple more months to go this year. So we'll see what happens, keep our fingers crossed. But generally speaking, if you consider climate change, the industry's point is that looking backwards 3 years or 6 years kind of at a high level just to project losses is not going forward the best way to do this, because we've got this different dynamic moving forward than we've had in the past. And so they are looking to use wildfire models to project losses. That is one of the big keys that they would like, that the regulations currently don't allow, other than for earthquake or fire following earthquake. And again, that's primarily, both are catastrophic events, wildfires and earthquakes. But earthquakes, going back a number of years, were viewed as a much more infrequent event with higher severity. It covers a wider area and much more damageability to many more buildings, versus wildfires, which were somewhat more common than earthquakes and are somewhat more contained and don't hit as many structures. So there was kind of a difference in allowing modeling for earthquake and fire following earthquake versus not allowing for wildfire. But the press now is on, because of recent changes and recent experiences in wildfire, to push for modeling. So let's go ahead and move to the next slide. And again, this was another issue that was brought up quite often at the investigatory hearing this past Monday, the use of models to project losses. So I said this was kind of a two-step event or two-step process. And if we dig down a little bit more on projected losses, one aspect or one component of projected losses is what's called a catastrophe adjustment. And basically, for the catastrophe adjustment, if we were just to rate looking back at the past 3 to 6 years, and we just look at all losses, that's non-cat losses or catastrophe losses, because catastrophe losses are so spread out in theory, you may get a number of good years with no catastrophe losses, and the rate indication may be, oh, they're overpriced. They need a rate decrease. And then you have a year or 2 years with catastrophe losses, and then the loss ratio spikes up, and then all of a sudden the indication is this huge increase. And I heard this term earlier, whipsaw. You want to avoid the whipsaws on the rates. You want to temper or smooth the rate indications. And so the way the catastrophe adjustment generally works is that from an insurer's losses, you remove the catastrophe losses from that portion. So you just have your base non-catastrophe losses, and then the catastrophe adjustment. And again, for homeowners, the way the regulation is written, you go back the past 20 or more years. So you take a longer period, you look at all of your catastrophe losses. In that time, there'll be flat years or 0 years, and there'll be years with bigger spikes. And you average out the losses for the catastrophes over that year, and you apply a relativity to your non-catastrophe losses. So you smooth it out. You get it to a point where it doesn't fluctuate as much, or at least over the past 30 years, it hadn't fluctuated as much, because you are smoothing it out and you're applying an average across a broad period. But again, with climate change, the push has been that the past 20 years losses, that reflected a different time, different climate, different aspects in terms of buildings that may or may not have been built into the wildland urban interface, or the WUI as it's sometimes called, and the dynamics are different. And so you can't really look backwards to get a good projection for projected losses going forward. And again, the push here is to use catastrophe wildfire models or wildfire cat models in using to project losses. And again, another theme of the hearing this past Monday was the push to adjust the use or application of how the catastrophe load is applied, get away from this past experience of 20 years or more, and have a reliance on catastrophe models. And just kind of in general, catastrophe models, we've got maybe 6 to 8 companies that are out there working. They might have models out there now or finishing up models. So this is kind of a newer approach. This is a newer aspect within the last number of years, last decade or so. And there are some questions about the reliability and accuracy, as we would have as regulators, making sure that if anything is entered in, to the marketplace, that it's done correctly, and we want to make sure that, you know, it doesn't harmfully impact consumers that much. So again, the focus of the hearing is if we're going to look at wildfire models, we need to address availability and affordability concerns that those models might have. And another thing I will say in general about the department is it is a very consumer-oriented department. We are more kind of geared or focused to consumer protection. And as part of consumer protection and as part of the rate filing process, everything that's submitted in a rate filing must be public. We believe that the public has the right to scrutinize the rate filings, look at the rates, look at the processes that are used to develop the rates, look at the underwriting rules, look at the rating rules, look at the forms. Everything in a rate filing is public. And the public has a right to know what's going on. So if a model develops a score based on policyholder attributes or property attributes, and I'll use the example, if a model has a scoring of 0 to 50 or 1 to 50, and the model takes the characteristics or information of the policyholder, runs it through, and it says you're a score of 37, and 37 out of 50 is pretty high. 1 is good, 50 is bad. The model says you're 37. So the insurance company using the model says, well, the model says you're 37. So you either don't meet our underwriting guidelines and we won't write you, or this rate increase, you know, you're going to get a large rate increase. And the consumer or policyholder, you know, what can they do? Well, if they can, you know, try to talk to the company, well, can you explain why I'm a 37? How did I get a 37? Is the data going in right? Is there anything I can do that might improve my score down lower, where I could maybe get an offer of renewal or an offer of insurance, or even get a lower rate? And so, you know, we want to see, you know, all of this, not only by statute where it's required that there's a public disclosure in the rating process, but that the consumer has some mechanisms or some recourses available to them so that they can ensure that the information going in or the score coming out is accurate for their situation. And one of the hurdles that we would have to deal with if we do address this and look at models further is this public disclosure requirement, because the third-party modelers, or whether it's an insurance company or a third-party modeler, certainly they have their own proprietary information. You know, it's their intellectual property, it's their hard work, it's their money, it's their effort, it's their years of using wildfire scientists or experts or actuaries or whoever to build this model that they want to use, and there are competitors out there. And I understand they don't want any of their, you know, secrets out there in the public. But again, they're coming into a highly regulated state with a very public disclosure policy. And so it'll be interesting to see as you know, now that we've concluded the hearing and we're going back looking at comments, you know, what direction this takes and where we go, and if or when or how models come into the picture. So it'll be an interesting discussion once we get there, if we can find a middle ground or not. But generally speaking, it is the industry's push to be able to use wildfire modeling to project losses on kind of looking forward basis, as opposed to this kind of backwards looking at the past that may not capture today's climate change or other changes in where people are living or building codes or whatever it is. So I will ask to go ahead and jump to the next slide to move past catastrophe. And I will address the concept of reinsurance, which was talked about in the last session to a great length. And going back to the beginning of Prop 103 back in 1988, when it was passed and took effect in 1989, anecdotally, I was speaking to an individual a couple weeks ago who used to work at the department many years. I didn't know him, but at the time, Commissioner Roxanne Gillespie had a decision to make when putting together the regulations under Prop 103. One of those tough decisions was, does the department allow the cost of reinsurance or reinsurance costs, benefit and cost of reinsurance, is that allowed into the rate making formula, or does that get excluded? And in talking with this individual, it was mentioned that this was a difficult decision. Roxanne did not take this lightly. She contemplated on this and ultimately decided, as we see here in the reinsurance regulation, that no, there would be no cost of reinsurance, no cost or benefit passed through to the policyholders in rating insurance. And part of that reasoning is the reinsurance market itself is not regulated. So the reinsurers are free to set prices according to their market, according to the competition. There is no regulation of the reinsurance market or the pricing. And the department did not want that unregulated entity coming into a regulated or highly regulated environment. Another consideration, and again, going back 30 years, was that one view was that reinsurance was somewhat of a choice of the insurance company. It's the insurance for the insurance company. There's no requirement that an insurer get reinsurance. Now, it may be prudent for them to do it in certain instances or certain risks, but there is no requirement that they get reinsurance. And given that it was somewhat of a choice, again, that what led into the decision. So 30 years forward to today, we stand at the regulation that says there shall be no cost for reinsurance passed through to the policyholder. But recently, again, back on homeowners and the wildfires that we've seen, reinsurance costs have gone up dramatically in the past few years. And this is putting a lot of pressure on insurance companies because they are paying more for reinsurance, yet they cannot turn around and pass that cost through to policyholders, which is what they would like to do. And because their capacity is somewhat limited or they can't get as much reinsurance, the option, or one of the options that they are doing, is they're looking at their portfolio and they're trying to determine where they might be over concentrated in certain wildfire areas, and they want to manage the risk. And over the past few years, we've seen a lot of policyholders get non-renewal notices. And so I think the push here from the industry is that if the department were to go back and revisit this regulation and address it and allow some form or fashion of reinsurance costs to be passed through, that would take some pressure off the industry. They would be able to purchase more insurance with the additional premium they could get that would cover that. They could reopen up some of their markets to some of the wildfire areas, and they could renew some business that they would otherwise non-renew, or maybe venture into new areas that currently they do not write. So again, big thing mentioned at the hearing this past Monday was the concept of reinsurance and allowing the cost. So kind of all these tie together, all these areas of the regulations that the insurance industry has struggled with or has looked at wanting to change over the years. The biggest ones are the ones that came up on the hearing this past Monday, and reinsurance is certainly one of those. So let's go to the next slide. So that's kind of the third part of the topics that Annie and I are discussing. And I want to move to some recent legislation. And at the time we were putting this together or considering what topics to cover during the session, there are a couple bills out there that really stood out. There were Assembly Bill 2167 and Senate Bill 292. 2167 is here. And the language that's up is the language that was initially introduced. And so as initially introduced, Assembly Bill 2167 would have kind of addressed some of these regulatory aspects that the industry has been looking at, hoping to change. And so generally what these two bills would have done is they would have established an insurance market action plan, or something called an IMAP. And individual counties in California, they would qualify for IMAP status based on a formula that was contained in Senate Bill 292. The insurance companies, again, on the homeowner side, aside from the current or regular rate filings, they could submit separate designated IMAP filings that would address rating in these designated counties. And they would have to write a certain minimum amount of premium in these designated counties based on their overall California total premium. So there'd be a ratio of premiums. So if they wrote a lot in California, they would have a higher percentage that they would have to write in the IMAP counties. And if they were a smaller insurer, they would have to write a smaller percentage. The bills did include parcel and community level mitigation as part or consideration of parcel and community level mitigation as part of it, which the department does like, and many consumers do want to have mitigation considered in their rating and premium determination. And we can jump to the next slide on 2167. And some additional parts of 2167, it would allow rates to be based on a complex catastrophe model or wildfire model, which again was one of the pushes of the industry that the current regulations don't allow. The bill would allow for reinsurance costs, again, just spoken to in terms of currently not allowed. The bill did limit the department's review time to 120 days, which is, from the department's view, was a little bit problematic putting that hard of a cap on it, because some of these could be very complex and a lot of issues. It could take time. Now, 120 days does seem like a long time, but it does go by quickly when you've got stacks of these filings and lots of other filings that you're working on. So the 120-day issue was a concern for the department. And if the review of the filing was not completed in 120 days, the filing would automatically be withdrawn. And then the insurer was relieved of their obligation to meet a certain minimum % of writing in these IMAP counties. Let's go ahead and jump to Senate Bill 292 slide. And that, I mean, the two bills kind of worked in conjunction, so they paralleled and somewhat mirrored each other. But Senate Bill 292, in working with AB 2167, 292 determined the basis for a county qualifying for IMAP status. It mirrored 2167 in IMAP filings and the requirements for filing. It set various report requirements for the California FAIR Plan to address. It established a state commission to address wildfire matters, and it also created a catastrophe modeling committee. Now, some of these on their own are not bad, are pretty good ideas, but overall, the bill was problematic for consumer groups. There were certain aspects of the bill that the department was unsure about and would like to have seen changed to better address the situation on some of these. And so as we got towards mid to late August and in this very strange COVID legislature session that went on this past year with really no one in the Capitol at times to address these bills, late August, there was a major significant revamp of these bills. And basically the entire bills were pretty much gutted from the language that was in them that had everything initially. And I'm going to read here just to make sure I get this correct, but Assembly Bill 2167 basically was boiled down to one paragraph, one short paragraph that required the commissioner to investigate, study, and prepare a report that addresses specific issues relating to rate making for residential property insurance policies in high fire risk areas. And Senate Bill 292 was basically boiled down to one sentence, which required the commissioner to complete a study on wildfire risk and insurance, including market-based approaches. So given that those bills were drastically changed, it's my understanding the authors of the bills decided not to pursue them and to go ahead and not have them heard. And so they never made it to the governor's desk and obviously not signed. So even those minor, the paragraph and sentence provisions of the revamped bills are not in law today or won't be in law next year. But that does raise a question, given the hearing that occurred on Monday and that we are looking at some of these issues specifically related in the bills and brought up during the hearing. You know, it'll be interesting to see where we go with the information once we've had a chance to review all of the written comments that we've received, which we've gotten a lot, and go back over some of the public comments that were given during the hearing to see where this goes. So I don't know where this will end up or what we will see, but we are only a few months away from the 2021 legislative session beginning up again. It will be interesting to see if there are bills somewhat in alignment with these two bills that didn't make it this year, or how this hearing process and what follows from it impacts that. So again, no crystal ball here either, but it would not surprise me if in the next legislative session, there were other attempts, similar attempts, or parallel attempts to get something through the legislature that has some of these aspects of these two bills, but we'll see how it goes. And so with that, that wraps up my portion of the coverage. And I want to turn it back to Annie because she has some extremely exciting news that she would like to pass along.
Thanks, Ken. So I'm going to share another screen with you guys. Can you guys see it? I'm sharing the department's website right now.
It's up on my screen.
Okay, perfect. Okay, so we do have a couple of vacancies here at the Rate Regulation Branch. I'm going to walk you through the process of applying if you are interested, and I'll also put my email address in the chat box afterwards if you want to ask me some additional questions. But I did just want to go through the process really quickly because although the first few steps can be intuitive, the last step may not be that intuitive. So you're going to go to our department website first, and then you're going to go to the About Us section, over to career opportunities, and then job vacancies. And then our entry level position is called the insurance rate analyst. So if you just type that into the search box, it'll pop right up for you. We also have some vacancies for our journey level position, and that's called the associate insurance rate analyst. So if you do have 3 years of underwriting experience or you feel like you qualify, please feel free to apply for that journey level position as well. But because we do have a number of students with us, I'm going to go ahead and focus on the insurance rate analyst entry level position. So if you click here, you're going to see the Apply Now button at the top right-hand side. The one thing I do want to point your attention to is there is an important examination information section, and there's a link that's kind of hidden right here. If you click on this, it'll take you to the job exam bulletin, and you have to apply through that way as well. That one is for the exam. The way that you apply for the exam is through snail mail, so just be cognizant of that. Make sure you certify mail that. But if you apply to the job posting, you click on the Apply Now button. And this is the part where it's not that intuitive. The job posting closes out on November 12th, and you have these 3 selections here that you can pick. Unfortunately, since the application process for the exam is through snail mail, and that does take a length of time, what you want to do right now, since we are so close to November 12th, is to select that you have eligibility. And that'll allow you to apply for the position while you simultaneously apply for the exam as well. I will say that the exam is a self-assessment. So give yourself the benefit of the doubt without lying. We expect folks to pass the exam because it is a self-assessment. It'll ask you questions like, on a scale of 1 to 10, how good are you at Excel, stuff like that. So yeah, so the job posting closes out November 12th. Hopefully, you know, some of you will apply for that position, and interviews are expected to be sometime in December. So that's all I have to share on that. And with that, we can go ahead and take some questions.
Hey, Ken, this is Ed. And, you know, I can't help but contrast our discussion this morning where we were talking about the challenges that the legal environment present now, and that although they are significant, and as a person maybe doing rating or whatever, you'd need to take them into account, but we don't have the situation that we had in the mid 80s for those of us that were unlucky enough to be in the business then. How would you sort of characterize, you know, the situations that have produced some of that legislation? I mean, are we really getting close to the point where, you know, the functioning of the market will be have significant enough difficulties in it that dramatic action at the legislature is possible or is likely, or that's still a ways off? And that really kind of puts you on the spot, and you know, you can answer it to the degree you'd like, but I think that's really what's rolling through everybody's mind is sort of how close are we to a point where, you know, our legislatures are really going to have to do something and do something fairly major.
Well, again, this may be just more my opinion and may not be everyone's shared opinion at the department. But I think as far as the legislature, you know, I don't know that we're necessarily close to anything drastic happening. I mean, we've seen over the years little tweaks and changes here. You know, certainly some, you know, that benefit consumers in terms of, you know, broadening claims or instead of 24 months of additional living expense, it goes to 36 months. And trying to do other things with inventory. Do you need a full list of inventory or partial inventory? And a lot of things more on the consumer side, which does add costs to the policy, because if insurers are going to be paying out longer periods of additional living expense, or paying claims quicker, or not questioning, or whatever it is, I mean, it does add to the cost, and ultimately that filters in through the rate process back into the premiums that get charged out there. And the issues that have come up over the last now 3 years, since 2017, it is primarily wildfire driven, and the losses from wildfires. So you've had a lot of consumers that were underinsured. That's a concern that, the amount of coverage up front was insufficient. You've got issues with building code and upgrade coverage where do you charge at the time the loss occurred, or do you look at the building code and upgrade when the building's rebuilt, 2-3 years down the road? And there are all these other concerns. So it's like a little bit here and a little bit there. And I don't know that it really is pushing into the legal side of it too much. But it's just, every year there's a little bit more gains for the consumer. And I know the industry, they want financial stability, as does the department. We don't, when Merced Property and Casualty, unfortunately went under because they were very concentrated in Paradise. And when Paradise burned up, I mean, they didn't have the appropriate reserves and surplus. And, that's the only company that has had that issue, fortunately. It's bad that one did. But I think, just in terms of the legislature, it's trying to address the availability, the affordability aspects, complaints that consumers have sent either to the department, to the insurance company, sometimes to the press, to their agent, to the commissioner directly when he was touring some areas, and just trying to respond to those and fielding what are the most common problems, what's the biggest issues we're seeing. If it's, claims denial, if it's underinsurance, if it's debris removal, that was another issue a couple of years ago. So, I mean, there's a lot of these issues out there. But right now, I think the biggest push is because of the wildfires and because of the way that the industry is submitting rate filing after rate filing, and the indication that the premiums charged now in the wildfire areas aren't sufficient. They need more, and by not getting more as quickly as they want, we're seeing more non-renewals. So non-renewals are a big complaint, but even if they can renew the property, on some instances, the premium is so high that the policyholder can't afford it. So I don't know where this middle ground is, and it is a tough situation that everyone is in. And so again, by this hearing this past Monday, the department is now trying to work based on some of the feedback there, based on what we've seen in the legislature, based on previous laws that have been passed in the past couple of years, and trying to get to this point. And maybe we're still in this up part, but at some point it should level out and things will smooth out again, hopefully. Again, no crystal ball, but it is tough. And so it'll be interesting, as I said, when we get to the next legislative session, what bills are going to be there, who's going to introduce what, what are we going to see, what will make sense, what won't make sense, and how is it addressed and how does it play out? And that by that time, what have we found out from the hearing? What other avenues could there be in terms of what about reinsurance? What about the use of models? What about anything else in terms of interveners or hearing processes? So yeah, I don't think that legally we're that close to anything drastic, but each year that goes by with only little increments, the pressure is still building. So we'll see what happens.
Yeah, that's very interesting. I mean, you look at some other areas around the United States with issues with climate change and rising seas and stuff like that. It's rare that we in California sort of look at our problems as maybe being not quite so bad. But I think, if you're South Florida, you would be you look on with envy to what to what we need to solve out here. So Hey, one other point that I'm seeing in our points in here about parametric insurance, and I know you covered it a little bit, but I'm not sure whether there might be. It seemed like an area of great interest. And do you see that as building within the department? You know, that the number of filings, the amount of interest, the number of inquiries, and things like that is building, or because it does seem like it's quite interesting to the members of this group today.
Yeah, I mean, from my perspective, the interest in parametric products is building. You know, we received our first parametric product filing, as Annie mentioned, late last year, about a year ago. And we've had quite a few inquiries into other products. You know, we did get one on hemp production, which I believe is still under review. We've had the earthquake one. There are more products being written in the surplus lines or the non-admitted market, so we don't get filings or anything on that. But, you know, we have gotten quite a few inquiries or reach outs or phone calls just to explore the idea. Not that a company was necessarily going to file anything with us immediately, but just kind of floating the thought out there, you know, what do you think of this? One of them had to do with construction and weather and delays in construction due to weather. It was just kind of a high idea concept. So we're seeing them, you know, not only for flood was another one, flood insurance or flood parametric, the construction, crops or hemp production, anywhere where there could really be a catastrophic event. So even wildfire, there's been talk of parametric wildfire products. So I think the interest is growing. I think it's still pretty early on in terms of what companies are looking at, but we've seen at least 5 different areas where the thought is there to put something together, and we've gotten 2 filings, and we know on the surplus side or not admitted there are more. So yeah, I mean, it is growing, and I think we will probably get more calls to talk about new and innovative products on the parametric side.
That's neat. Hey, other things that are appearing in the chat have to do with the openings, and I mean, I can only reflect, you know, on my colleagues that work in your area, that how much they enjoy their job, and these are people that have you know, have extensive experience throughout the industry, and the fact that they find the department a really satisfying place to work, I think speaks well for it. But you guys may want to talk a little bit, given it just a little bit more about sort of what the position's like, and you know, what sort of advancement opportunities these folks have, that type of thing. Because based upon these questions, it seems like you've got some interest. So go ahead.
And I may have Annie jump in here too. But I mean, generally speaking, when you're talking about the insurance rate analyst position, the entry-level position, the primary aspect is when we get the rate filings in and review them, we are looking to ensure that the rates are not adequate, or the rates are not excessive, inadequate, or unfairly discriminatory. And we have a rate template that takes a combination of the insurer data, and it merges some department parameters, you know, because we have set expense load or efficiency standard, we have surplus ratio, we have leverage ratio, we have various parameters that are set by regulation, and it merges the two in this template, and it results in a range of allowable rates. And so primarily the analyst is looking at the rate template of the filings, but the filings contain other items like, you know, rules, forms, you know, we'll look at rate impact at any forms or manual rules. We'll look at underwriting guidelines to make sure they're not unfairly discriminatory, and see if any changes in guidelines impact the rates. Because as a very high level example, if a company currently for homeowners is writing, you know, score of say 0 to 10, but they've decided they want to pull back and they want to only write 0 to 3, say. So anyone who is a 4 through 7 is going to end up getting a non-renewal because they're changing this guideline. That changes the insurer's mix of business. That changes their portfolio and the losses they had in the past based on their business mix of 0 to 10 scores. That's not going to be the same in the future. So the past experience is not indicative of maybe a portfolio of 0s, 1s, and 2s. or 3s going forward. So there has to be some adjustments to the rates possibly because of that change. So we look at a lot of aspects in the filings, and that is the primary, the work aspect. There are other, special projects that come up. There are other functions or other things, or coming to talk to groups like this. And so it is a lot going on. We do interact with other branches within the department, with our consumer services branch, with our legal branch, and with others, because we'll have questions on rate filings, legally, how does this look, or what we get opinions from our consumer group staff. So it is a collaborative effort. It's not just us on our own, although we're kind of on our own at our homes right now. But we do reach out, we do interact with other parts of the department, which is good because we do want to provide a consistent message to the industry. We want to treat everyone fairly and treat across the board. We don't, treat companies differently. We try to do it the same, but again, we're human. We're a big branch. We've got, up to 90 people or a little over 90 positions with some vacancies. And the human element sometimes gets in and people miss things in filings, and something will get through on a filing that maybe shouldn't have, and it'll get picked up later. So we are human. We don't catch everything on the first time, but we do our best. And, it is a good group to work with. I've been there, 31 years now, and still there. So, and
Well, Ken, that's the point I was going to make, is that the people that are leading the department, Joel obviously is retired, but certainly recently in a leadership. You guys joined the department and have spent your careers there and have enjoyed a lot of advancement. So I just wanted to make sure in this situation where we're talking about your opportunities that people don't see these as just a place to park yourself for a year or two. This is a place where a lot of folks have really made really good, long public service careers.
I see Annie nodding her head yes. So Annie,
I'm glad you brought that up, Ed. No, I was just going to echo what he said. I mean, absolutely. I think we have a very family-oriented culture. A lot of, I guess, the first generation of Rate Reg grew up together and went through a lot of milestones together. It's a great place to have a career. Your coworkers really do become like your second family, and hopefully the new generation of Rate Reg continues that culture. So I think it's a great place to work. You start off as an insurance rate analyst, and you progress through that entry level position for about 3 years. And then we have every expectation for our folks to become associates. And at each range, you get a 5% bump. So that's awesome. And when you become an associate, you get like a 15 to 19% bump. So it's a great place to build your foundation for your career. And that's the only thing I wanted to add.
Cool. Well, this has really been a marvelous discussion, and given everything that's going on in the insurance world that you guys have to keep under control. I mean, we could go on for a lot longer time, but you certainly used the time that we provided you, Annie and Ken, very, very well, and we appreciated your participation today, and hopefully you guys enjoyed it as well.
Yeah, it was enjoyable. I like doing these. I like them better in person. And I did learn from Joel Loucher on presentations where he does make people sing, and he does interject some humor and some audience participation, which is hard to do in this format. So I don't know when we'll be able to do anything in person again, but no, I think these are beneficial not only for us, because when we're in person and interacting people, we learn things too. And we're always learning every day. There's new stuff. We're learning about parametric products every day, it seems, or other things. So it's good for us to get out and interact. I mean, not only with the industry people that attend these, but students or anyone else interested, or insurance geeks, whatever you want to call them. It's good for us too to do this and collaborate and share and learn, as well as the people who are listening to the presentations.
Well, Ken, Annie, thank you ever so much. And with that, I'm going to turn the program back over to Jeff. And good, you were there, Jeff. I don't have to, sort of fill the dead air. You take care, and thank you very much. And I'll let you take over.
Thanks, Ed, and thanks again to Annie and Ken for your insightful remarks and your service to the state of California. Thanks again to all of our speakers, sponsors, and attendees. A special thank you for CSUN Center for Risk Management and Professor David Russell. And this concludes our California and Hawaii CPCU Virtual All Industry Day. I hope you enjoyed the program, and we hope to see you in person next year, or maybe we'll even do a hybrid in-person and virtual event. For those of you who missed our morning presentations, probably most of your folks in Hawaii, we will start the presentations, the recording over again momentarily. So stay tuned and have a good afternoon.